Late last week, we saw the Lyft IPO come to market, and I viewed that with a bit of skepticism before, and I don't intend to sound like Monday morning quarterback, but I had these thoughts prior and didn't really get the opportunity to voice them in the way that I'd hoped. Quite frankly, I got bumped from a TV appearance where I was supposed to discuss it. But let me give you what I was supposed to give them and some thoughts for the IPOs coming forward. I got very nervous when I saw the price talk on Lyft keep rising. That to me, a lot of times that's a good thing where you see investor enthusiasm. But I started to worry that this was investor enthusiasm for the wrong reasons. We haven't had a lot of IPOs. We're in a period where you can argue that a lot of the market movement is driven by FOMO, fear of missing out, as much as it is really a search for good investment ideas. And when you see the IPO price talk jumping right before the IPO, in an environment like that, you have to wonder, or is it more just people wanting to get in on the next hot IPO and avoid, and not necessarily because of any great fundamentals? The problems I have with Lyft and the Lyft IPO as it was done is there was a fair bit of hype around it. Now, there's always a natural bit of hype around most IPOs, especially ones where that resonate with consumers. I'm really not one to belittle the IPO process. That's really why we're all here. Those of us who invest in the stock market and make our living from the stock market. Basically, if companies are not able to use stock markets to raise capital via equity financing, there's really no point to the whole game. And so from that sense, I'll never be one to belittle the IPO process. I do start to wonder, though, when you start to hear too much talk in the general press and general media about a particular name. In the case of Lyft, very specifically, what you saw was a company that really is bleeding money. Losing $800 million last year, without an obvious path to prosperity, and really without even a leadership position in its own industry. You can certainly argue that they are number two to Uber's number one. Throw in also the fact that the sellers are, at this point in a lot of these unicorn companies, the reasons they have these big valuations is they've gone through multiple rounds of financing. And so the original owners have, if not been completely supplanted, but certainly have been joined by groups of professional investors, venture capitalists, private equity, large funds that have been able to buy in advance of the company going public. And they're going to be a bit tougher about getting a high price for themselves. They're more, in many cases, more about the transaction than about the long-term growth. And so what I had hoped to tell people beforehand was, be wary. I think this is a tough company to value, and therefore it's a tough company to invest in until or unless you see the path to prosperity, the path to profitability really reveal itself. It actually brought up something interesting. The first time I ever appeared on TV was right after the Facebook IPO. And I rewatched it, and the question then was, would you buy Facebook here? And remember, Facebook had sort of the similar process into its IPO. It was very frothy going in, and my comment then, as it is now, is it seems very frothy. I'm referring to Lyft, not Facebook, but at the Facebook at the time, seemed very frothy. I would let it settle out a little bit, and when you see that path to prosperity, that's when it becomes a good investment. I think the same applies to Lyft and the myriad other IPOs that are coming down the pipe over the next few months. Keep an eye on the profits, keep an eye on the market leadership, and I think you'd be much better served.